Okay, now we're beginning the chapter on investing in bonds. We've kind of touched on bonds and some other stuff with taxations and investments, the general chapter on that. So we'll give you the high points that you need on this. Um, what is a bond? That's always our first question. So this may help summarize it just a hair better than I've done.
What is a bond? Presented by Wall Street Finance. Bonds is a contract for a company or government to pledge money for a fixed or period of time in return for interest payments. Think of it as a property or company taking out a loan against an individual. There are two kinds of bonds, coupon and zero coupon bonds. With coupon bonds, the lender owns the security. Zero coupon bonds owns the security. Coupon bonds, on the other hand, are fixed security. The lender owns the security. Coupon bonds are zero coupon bonds. The terms of lender note are different. Fixed securities introduce coupon bonds, while securities with zero coupon bonds. Key things to look for in a bond are interest coverage rates. What is paid interest paid? Lender lifetime repayment period. Pay on time. Bonds are to be funded. Deployment period. Bonds are to be deployed. Securities rates. Bonds are to be deployed. Securities rates. To take advantage of market volatility. Coupon-paying bonds. Selling shares in this business can be tricky, but RT has no interest in losing its ownership. Taking out a loan from the bank can be easy, but it would be on the bank's terms. Maybe RT has already been accepted credit from the bank, or isn't happy with the interest rate the bank had targeted. To avoid making issues, RT signs issue bonds. It sets credit interest rates for companies and sets a coupon rate. It does not sign long-term bonds that offer value over return. Since the typical coupon bond sets the rate as average, RT uses rates plus possibilities to negotiate its coupon. Remember, RT owns the expiring coupon. To acquire capital bonds, RT manages capital losses at the bank by interest rates. To allocate capital securely, bonds are a safe place with no returns after investing. Don't be fearless. Every dose of investment matters. Learn more about bonds today in class at our Wall Street Chicago PowerPoint.
And as you said, bonds aren't necessarily your get rich quick schemes or anything that you're looking at long term investing, typically with bonds, like you saw with that example there. The thing about bonds that always makes it frustrating and hard for those of us in the investment world is that they have their own lingo, like you just saw: face amount, maturity date, coupon, no coupon. So they have these little buzzwords they like to use, but we'll go through each one so you'll have a good grasp of them. Um, the legal condition that is done, like with the guy that was just trying to figure out how to get some capital and stuff, that is described as a bond indenture. So like you have a loan agreement, if you have a bond, it's a bond indenture is what they call it. Bondholders usually receive uh, interest every 6 months. Typically, that's the kind of standard rate there for when interest is paid. They can pay it anytime they want. I mean, they can set it up quarterly, they can set it up monthly, they can set it up annually, but typically bonds pay every 6 months. Um, Corporations want bonds for, like the example just showed, needing money for purchases or to expand. They want to finance business activities going on. Maybe it's difficult to sell their stock. They've maxed out their stock. They're watching their price earnings ratio and make sure that they don't issue more stock just to have paper stock because they wouldn't have the assets to cover it. And then it kind of gives a corporation's financial leverage too by doing that. Because again, as I mentioned, you end up being the lender to the corporation that's doing this investment. Um, there's a debenture bond, which is not what you put in your teeth. Those are dentures. A debenture bond is most corporate bonds fall into that category, and that means they're unsecured. So it's kind of like when you get a loan at the bank and it's unsecured. They're just doing it because they like you, or you have the assets, but they're not attaching any of your assets to it. That's the same thing with the corporate bond. They're you're lending them money, but you're not necessarily asking for some kind of collateral for it. So it's considered unsecured, and you're using the reputation of the company. Again, key word in that is you want to be sure it's a reputation you can trust. There can be a mortgage bond. Same thing as the debenture bond. A corporation can do it, but typically then it is a secured bond, and it may be secured by the real estate, which is where the mortgage term comes in. They may not have a mortgage on their real estate. They may, and you're attaching to that mortgage. But if not, then you're giving them you're giving them money, and there's a collateral in there of the real estate. So should they go under, there's something there to secure it to make sure that the people are repaid. Um, Bonds, you need to keep in mind that bonds are debt financing, and then they have to be repaid at maturity. Stocks, on the other hand, are considered equity financing, which means there's it's a plus money. Interest payments for bonds are required. Stocks don't require dividend payments. Stocks don't require interest payments. They don't require any of those things. Bondholders, you have the first claim. If that company went under and you're holding a bond, you have first claim to assets. Stockholders, not the same. Now, preferred stockholders may, but stockholders are usually paid after the bondholders and other creditors. So just because you own stock in the company doesn't mean you get paid first. It means you kind of fall down the ladder a little bit there. And then bondholders are different because you don't have a right to vote. I told you when you're a stockholder, you have a right to vote for who's on the board, and that the budget this year is good, and etc. So you don't have that with a bondholder. You're in a different capacity. But as a stockholder, you do have that right. There can be a convertible bond. A convertible bond a lot of times means that you're buying the bond now, you're giving them the money now, and instead of them actually paying your $1,000 investment back at maturity, they may then turn that into giving you stock. It could be at current value. They may guarantee how many shares. That'll be in your debenture. That's your legal agreement between you, the two of you. But it'll tell you what they're going to do. But that's considered convertible. That just means it can be converted from a bond to stock when it matures. There can be a subordinated debenture bond, which is like way more than you need to know. But basically, it's an unsecured bond, but it gives bondholders a claim to having some kind of mortgage or something like that would give you, that you don't normally get the claim for an unsecured, but it gives you some claim with that, with respect to interest payments and etc. High yield bonds are corporate bonds that pay a higher rate of interest. A lot of times, especially if a company's having trouble with financing, or they want to get the financing like really quick, they may look at what interest rates are. Like say interest rates now are 4 and 5%. They may offer on the bond rate 8 or 9 or 10%. That's more appealing. That makes you jump in there. Now, the thing to keep in mind is if it's a high yield bond, check it out and make sure that it's not. Typically, if they have a higher rate of interest, they have a higher risk of default. And the reason is if they're offering you 10% and you could only get 5% if they invest it, they're offering a big chunk they're offering you a 10% return. That's great, but can they make that 10% return? So that happens a lot of time with high yield bonds, that they'll go under, or they don't pay at all, or you only get 2 or 3 months, and etc. And then sometimes they're referred to as a junk bond. You may hear people say, I bought a junk bond. You think, why would you buy a bond on junk? Well, what it just means is there's a good chance that you won't get anything but the interest payments. You may lose your principal, or you may not get interest payments, but you get some, and then you have your principal. So just keep in mind that, it's not there. If it sounds too good to be true, my rule of thumb is if it sounds too good to be true, it probably is too good to be true. So always check into it. My other rule of thumb is if a bank or a bond company or someone is offering a really high rate of interest, there's a reason. They need your cash. And as long as you trust them and believe that, it's okay if you lose that, or your cash, especially like with a bank, is guaranteed up to the 250,000, you may decide it's worth that risk, to have that money tied up. But just keep in mind, if everybody's paying 4 and 5%, and you find a bank that's paying 8, 9, or 10%, they're going to need your cash. So keep that in mind. And the same thing with bond companies. If it's a really high difference from interest rates, when typically they work inversely, which means if interest rates are up, bond rates are down. So if you're finding something that's not following that pattern, there could be a reason for that. Now, I will tell you, our current market is completely blowing all those theories out the window. Typically, if stocks are up, interest rates are down, and if interest rates are down, bond rates are up. So you have stocks and bonds up and interest down. If interest goes up, then stock and bonds go down. Right now, all of them are kind of trending upwards, and it's a little harder to give that theory. But in theory, that's what we're taught in finance, and that's what you're taught in this class. Just know that this market is not that. This market is not reacting the same way. So it's a little hard to make a lot of predictions out there with this market. Call features. They may decide the company that you're borrowing money that is borrowing money from you that you're lending to pay for their project. They may finish it early, and if they finish it early, they may want to quit making interest payments. So it could be that they'll quote unquote call it in. Think of it like they call you on the phone and tell you, "Hey, I want your bond back," and they'll buy it back. Only thing that you're losing is the interest that it would have earned from that point to the end of the maturity. And sometimes people might say, "Well, if they call it early, you just lose a lot of money." Well, you could, but it's not money that you actually had. So you always get the return of your principal, and then you're just losing those many months or years of interest payments. So that's something to keep in mind too. Most agree that they don't call bonds for the first 5 to 10 years. So very rarely is something issued year one and called year two. Um, as anyone can see, if you've ever tried to redo something in your house or build a house or work on a project that's building something, you run into more delays than you do getting it done early. So typically they're not done early, and they're done they're done in the latter of the 5 to 10 years after they're issued. And if their interest rate is much higher, like say you've got a 10% bond out there and then our interest rates drop to like 2%, they may call them, even though the project's not finished, and then reissue them at a lower interest rate because they can't, unless they're making money hand over fist, they can't afford to keep paying you 10% when stuff they've invested in is only making 2. So that can make a big difference too. Um, how they're going to repay you, there could be a sinking fund. Corporations deposit money into this and then use the money to pay off bond holders because they have to have a way to pay you back. Now, sometimes they'll just do a lump sum at the end of the project. They've been setting aside money all the time. Well, if they're setting it aside, that's probably what they're doing, is setting it in what they call a sinking fund. Because what it means is money's going in their fund, but then it's going to come out when the bonds are due. Cereal bonds, you may hear that and think, ooh, is that like breakfast cereal? No, it's SERIAL bonds. And it basically means it's a single issue bond, but it may have different maturity rates. It may be a $10,000 bond that 5,000 matures in 3 years, 10,000 matures in the other 5,000 matures in 5 years, and the other 5,000 matures in 15 years. So they may do something like that, and that's called a serial bond. You have one bond, but different maturity dates on that one bond for different amounts. And that's, again, to help the corporation pay out part of their proceeds as they go along versus one big, huge lump sum payment at the end. There's a psychology in everything that we do, especially in the markets, because we have a lot of emotions when you start investing your money in things. Emotions you may not know you had, but anyway, when emotions are involved, then we have a psychology that's tied on it too. Bonds are good for, as we looked at asset allocation in the first chapter of investing. It gives you something to diversify your investments into, so that all your eggs are not in one basket, as the saying goes, which really helps. Of course, you can look at some bonds are better for tax purposes. You can look at corporate versus governmental, and they may have different growth options. You may want to stagger them. Used to be way back in the day when people had babies, for baby gifts, they would give somebody like a 20-year bond or an 18-year bond or a 15-year bond, and they would could buy it at a reduced, it could buy like $1,000 now, or a lot of times they'd buy it at a reduced rate. They'd buy it like for $500, and then in 20 years it matured to being like 10,000 or 15,000, and that was gave you a start. When you turned 18, you had this bond that had been earning money, and you had interest on it, and it grew, and then you could cash it in and have cash. So that was one way to do that. So that sometimes can be a nice perk. Um, and then they may have, bonds have been known to have better growth rates, better stability rates than sometimes things that are offered in the market, or sometimes even compared to bank CDs, depending on how the banking industry is going. So they give a lot of stability, or can give a lot of stability. Um, the thing about them is they're long term is the thing to think about, but you can stagger them. You could buy one now and one in 5 years and one in 5 more years. And that way you have money maturing at different times and different amounts coming in from interest payments too. If you stagger when you buy them, instead of it being every January and December, you may have a January payment of every quarter payment if you stagger it out correctly. Um, Bonds typically are thought to help to prevent, if the markets downturn, they're thought to be the stability and the stable part of your investment portfolio. So while your markets may drop and your stock prices may drop and you can't sell them because you have a loss, bonds are not that feature. They're growing and they're continuing to be stable, and they continue on as they're doing. So, they can work a lot of ways. Again, and I say this just because it is on the exam, investors receive interest about every 6 months. The dollar amount is computed by taking the interest rate by the face value, just a straight calculation formula. If they're registered, interest checks are mailed directly to the bondholder of record. If it's a registered coupon bond, so only the principal's registered, checks are made to the coupon holder. Coupon is another way to say interest. And it used to be, I can date myself pretty quick on a few things, but when bonds used to be before the electronics age and everything was in an electronic age, you know how when you see those signs at a laundromat, or when you're out eating somewhere, and it'll have a lost dog, and then it'll have little squares at the bottom, or little elongated things that you can tear off with the phone number on there. That's how coupon bonds were issued. They were issued with perforated edges on the bottom. You got a piece of paper that was your bond, and then there were little, what they called coupons, at the bottom, and you'd have to turn those in every month or every 6 months to get your interest. And that way you knew that it had been paid, there was a record, and etc. So that's where that theory of having a coupon bond comes into play, because there was actually a coupon to turn in. Um, and so they don't always have that coupon thing now. And of course, with that bond, if I wanted to sell you my investment, I could give it to you, and then you would turn in those things. And that's where that check follows the coupon holder. If you mailed it in and said, I have the coupon, they would pay you, not me. So that's to keep in mind. They could have a registration issue with that way. There's a bearer bond, a good, um, you may hear that in some really good murder mystery movies. People get killed a lot for bearer bonds, because bearer bonds are not registered. They don't have my name on them. They don't have your name on them. There's not a coupon on there to register. They're just free and easy. And so if I stumbled on a stack of bearer bonds, nobody, I mean, if they were thrown out a car window or in a car wreck or in somebody's briefcase and I murdered them for them, those bonds could become mine. And so again, it's the theme of quite a few murder movies out there. But they're not registered, and they're not usually registered anymore in the U.S. Um, because of the murder rate, haha, but because of the liability of it. The fact that anybody that found the bond, anybody that got the bond, it's one of those things. If somebody broke in your house, they took your bonds, they now own them. So you don't find that as much in the U.S. anymore, but you do still find it in foreign countries, that they will still issue bearer bonds. Um, Bonds can appreciate. Sometimes the closer a bond gets to maturity, it may be worth more than that face amount of paper that you have that says it's $1,000. They can be traded on the stock market. A lot of them are traded. So that's something to watch if you decide you need some cash, or you're kind of tired of the bond thing, or you want out, is look and see what it's trading at. Is your bond trading at one of those above face value rates? Or is it trading just below face value and you're okay with a couple of dollars loss because you've already had the interest? So, you can make that decision. And so you could trade it off and alleviate yourself of that investment, take the cash and move forward. Um, Yield is the expected rate of return, if you hold it for the whole 12 months for a stated period of time. Typically, a yield is calculated on an annual basis. We talked about some Banks and different things will have an annual percentage rate and et cetera. Bonds just have usually what they call a yield, and that's the same thing as the annual percentage rate. What is it going to earn me for 12 months? Um, when you purchase the bond, you can hold it to maturity, sell it to somebody else, trade it on the market. You don't have to keep things until they mature. Again, a lot of this stuff's done online, so it's a lot easier to transpire than having a piece of paper that you have to endorse and sign and everything on the back. And then they call what they call a bond ladder is what I mentioned earlier, where you could buy bonds at different times and kind of balance your risk and return because bond rates typically were not a huge fluctuating, and they're not still not a huge fluctuating, but they may go up quite a bit in 2 or 3 days time or in a month's time or something like that. So you buy some today and then you go, yeah, look, that rate's pretty good. Instead of cashing yours in and taking the loss or doing something, you could just invest in some more and stagger when they mature. Again, staggers when you're getting cash, and also staggers when you're getting interest payments. So, doing something like that can help too. Okay, here's a typical bond transaction. Example is Ford. Assume that on March 23rd, you purchased a 9.95% corporate bond that matures in 2032, so 12 years down the road, with a face value of $1,000 issued by Ford. What does that tell me? Well, that means I purchased that at $950 plus a $10 commission charge, which would be spelled out if you had that. And it would have a total investment that I put in of $960, which means I invest $960, it's going to mature in 12 years at $1,000. So right there, I know I'm going to make $40. Plus, then there may be interest payments along the way if they tell me what the interest rate is. Assume we held it until 2024. So we held it 4 years. And then we sold it at its current market value of 1,180. So you can see it's already at a premium. So we invested 960, we sold it at 1,180 and a $10 commission charge. So we really sold it at 1,170. What does that net us? Well, here's where we can do the calculation, because we love to have calculations. There's where we purchased it on the left-hand side. Um, Left-hand column, here's the cost. Here's the return when we sold it. We paid 960. We got 1,170. So if we run it through our little thought process here, this is how much we pay. This is how much we got. This is how much we paid. Subtract the two. We made $210 profit on the sale. Then if it paid interest of $99.50 for the 4 years, so that was what the interest rate was, then we already got $398 worth of interest. So overall, we made $608 on our $960 investment. So that gives you an idea of what your rate of return is. You could then divide that out for a percentage if that was easier to see. But that way you can just make sure it's okay to sell it now because I've already made some money on it. So you're good with it. Most bonds are sold through a full-service brokerage firm, a discount brokerage firm, or on the internet, which means they're sold anywhere you can think of. Discount brokerage firms and the internet are going to have lower commissions. If you're just getting into the bond market for you may want to do your first one through a brokerage firm to be sure how it goes. But other than that, you can probably take care of it yourself. And then the brokerage firms charge a commission when you buy a bond and when you sell it. So you want to keep that in mind too, as you just saw in our last example. Commissions can be a stated dollar amount, $10 a transaction, as I think was in our example, or it may be a percentage of the face amount. It may be if you're selling it for $1,180, I'm getting 10% of that. So they can do that. Then there's government bonds. Those were all corporate bonds. Government bonds have the same lingo, but they have a different approach. A government bond is the pledge of the government or the municipality, because a lot of times you can buy local bonds. I think our local city had a bond issue that we voted on that they want to have bonds issued to help build the new school and a new swim park, I think. You can tell how much I paid attention. But anyway, so you could buy locally or you could buy nationally with the government, either way. And those are used to finance costs of the government or a project that they have, just like corporate bonds, same thing. The levels of government bonds are federal, which is anything that the government of the United States is doing. They have federal bonds that they sell. Now, the key on that is there's no state income tax on the interest. So when you're getting your interest payments, you just get those free and clear. You don't have to report them on your taxes. Or if you do, then they are reported as non-taxable, but you don't have to claim them as income. There's state bonds. Arkansas may have a bond and say bonds going on for projects that they have. Texas, Louisiana, Mississippi, Missouri. Then there's local, like I mentioned, the city of Fayetteville having theirs. Um, then there's a thing called treasury bills. Those are kind of like bonds, but different. We got to have something going on different all the time. Treasury bills have $100 minimum, so think of them as like a dollar bill. And then they have usually a 1 year maturity. They're going at a shorter rate than a bond. A bond's looking at a 5 to 10 year, 15 year, 30 year, something like that. Treasury bills are looking at a 4, 8, 13, 26, 52 week minimum. So they're looking at getting something done this year with that. They usually sell them at a discount, which means you're buying them for under what they will mature at. So for a $100 T bill, you might pay $90 for it, and then it matures at $100, and you'll earn interest too on it. Treasury notes, to be different from treasury bills, are sold in $100 units also, but then they have this longer maturity period, 2, 3, 5, 7, 10 years. Now they can't go as long as 30 and 40 like a bond, but they have a little shorter maturity period. And interest is paid every 6 months like a bond. But those are called T notes and T bills. T bills are 1 year, T notes are a little longer maturity. Then there's treasury bonds. So you have treasury notes, treasury bills, treasury bonds. They are sold and have 20 and 30 year maturities like a traditional bond. That's what they are. They're sold in minimum units of 100. Interest rates on bonds are generally higher than those of the bills or notes that we just learned about. Interest is paid every 6 months, and you can hold until maturity or you can sell them before maturity. They're also in that category of being able to do that. Then they have a thing called TIPS. It's the government. They always want an acronym. And so TIPS are Treasury Inflation Protected Securities. Now they're sold in $100 minimums. They usually have 5, 10, and 30 year maturities. The value is based on the Consumer Price Index, or the CPI. And then the principal increases with inflation and decreases with deflation. Interest paid every 6 months, hold into maturity or sell before maturity. So they're kind of like a variable product. They're going to go with the market, but they're going to go with the consumer price index. That's how they get their value, and then that's how they worry about what the principal is and what the the inflation factor or decreasing factor is on the face amount, deflation or inflation. So just keep in mind that those are a little more and like I said, because they call them inflation protected, they're kind of saying, hey, if you think inflation's going up and you buy them now, we'll continue to increase the face amount to match the inflation rate. Of course, then the thing is too, is if the inflation goes down, they could actually go down. So you want to be sure that you know which way it's going. These were current rates of 2025. This was a year ago, basically. You can see where the interest rates were for 3 months for treasury bills, uh, 1 year, 5 year treasury notes were at 3.6% for 2 years. So not a great interest rate. 7 years, but not as guaranteed for that whole time. So that's something to keep in mind too. And then the 20-year bond was 4.8, which was the highest of those. And then, well, up to that point. And then the 30-year bond is 4.83. So you can see how the bonds were had the most interest. And then the difference of the maturities for the bill and the notes gave you an idea of how they kind of work too. Then there's federal agency debt issues. Those can fall in the category of Fannie Mae and Ginnie Mae, and we talked about those when we were discussing about getting a home loan or something like that, and they may mention that you could apply for a Fannie Mae or a Ginnie Mae. Well, you can also invest in a Fannie Mae or a Ginnie Mae. So you can be the investor or the receiver of these kind of mortgage loans. And basically it just means you buy into those to provide mortgages for people who are applying. Freddie Mac is the Federal Home Loan Mortgage Company. They love to have all these little buzzwords. It's kind of cute. Fannie Mae, Ginnie Mae, and Freddie Mac. Sounds like it's a family reunion, doesn't it? Well, they're basically Government entities that are sponsoring mortgages, and they have different requirements for different levels of that, depending on who you are. Ginnie Mae's are the government. Fannie Mae and Freddie Mac are the federal national mortgage and federal home loan. So depending on, different people qualify for different ones of those, and so that's where that comes into play. But like I said, you could be an investor in that and give them the money that they get that they loan out, and that can be helpful also. Government sponsored agencies are not actually part of the government, and so they have a slightly higher risk than Treasury securities, but they also have a little higher interest rates also. So that's something to keep in mind. The minimum denominations may be as high as $25,000 versus the ones that the government did that were $100 each time. So you can see that it would not be for everyone. Um, Municipal bond. They also call those a muni bond. There's all these buzzwords. It drives me crazy. Sometimes I still have to sound them out to make sure I get them right when somebody asks me a question. But those are basically debt security bonds issued by state or local governments, cities, counties, school districts. School districts are notorious for having some kind of a bond that they can sell and promise to pay to help get something built, gymnasiums. They may use it for a new school. That's rare. Usually they can get federal funding for that. But if not, they might have a bond to help build a new school or revamp a new school. They use them for ongoing costs for major projects. Airports may have bonds. Bridges, they may have a bond for bridges. So they all would fall under that municipal, state, and local government securities. Um, they're classified as a general obligation or revenue bond. So they're going to pay you back, plus they're going to pay the interest. Um, they're backed by the government, of course, that you're investing in. That government could go under, your state and local government. It's very rare that that happens. It does, um, especially if they get bonds for everything they do and they just never pay them back. That could be a big problem. And then revenue means it's repaid from income generated by the project. So, like if they're looking at when toll roads go in, a lot of times they're put in with a bond. And then the tolls are used to repay the bonds. And then sometimes when the tolls repay all the bonds and the interest and et cetera, then they quit having a toll road, because then they no longer need it. So, it just depends on what's going on that you might want to invest in. Um, Municipal bonds are not considered as safe as U.S. Treasury or federal government issues. They also may be callable because if they finish the project early, they more than likely will tell you they don't want to continue paying it. For some people, like I said, they consider that a bad thing. For some people, they consider that like, okay, I get my money back and I've had interest for so many years. I'm good. I'm walking away. And then interest that you earn on them may be exempt from federal income tax. So they kind of have a perk there. Capital gain on sale is taxable for all bonds and all things that you buy, stocks, etc. If you have a gain, IRS wants to know about it. So a taxable bond, there's always people trying to figure out their tax equivalent yield because, it depends on, is this good for my taxes, bad for my taxes, etc. We have a formula. I'm not going to ask you about the formula, just know how the formula works. A taxable equivalent yield is a 3%. Say it's a tax exempt bond with 3% return. That person's in a 32% tax bracket. So if you did that and did the tax exempt return of 3%, and the tax bracket 1 minus your tax rate, so be 1 minus the 32%, then that means your taxable equivalent yield is about 4.41%. So if you're getting a 3% tax, you're getting a 3% bond interest payment. It may increase your taxes by 4.41% versus the 3% is what they're trying to tell you there. And that's where you just do the math. So you have the 3% divided by the 1 minus the 0.32, then the 0.03 divided by the 0.68, because that's the 1 minus the 0.32, and then that equals 0.0441 or 4.41%. So that lets you know kind of what you'd be looking at for taxes. They have a table. You can follow it through and kind of see if you're getting a 2% rate, what it would do for the different rates, etc. So you can see, of course, if you have a 5% yield and you're in a 37% tax bracket, it's almost putting you at an 8% taxable rate. That might be enough to make you question it, but it could not be. I mean, it may be that you, especially if it's a government bond and it's tax-free, that helps you on that part too. The internet can be used to get a bond quote, a bond price, to trade bonds. to do research, of course, about the company, the project, the corporate issue, the government issue, etc. Um, these are some relevant websites. You can check them on your own. But again, when you're researching on the internet, my big thing is just make sure you're always looking at a relevant website. Don't just go out there and, let TikTok tell you who's got good bonds. Follow it up with looking at FINRA, which is the organization that runs for the stock markets and stuff. Investor.gov, municipalbonds.com, treasurydirect.gov, Finance Yahoo, of course, you can look up with bonds. So just be sure you're looking up the right people. FINRA, who is considered the financial industry regulatory authority for stock markets and all things related markets, is probably the best place to start. And so it gives you that way you can kind of evaluate the quality of each bond, see what's out there, see what's going on, etc., and make your educated decision based on that. Bonds are quoted, they have a face value, and then they have a bond price, which is the face value times the quote. In the United States, bond price quotations are based on a clean price, which a clean price means is the price of the bond with no accrued interest. So if you're looking to buy a $10,000 bond, you're going to look at buying a $10,000 bond. Sometimes in foreign countries, especially, and you can have some that aren't clean prices in the U.S., but very, very rarely, and probably on a bad market, they might trade the bond at $10,000 plus interest for 6 months this year because it was issued in January, and you're buying it now. So they would add on 6 months of interest, and that's what you would have to pay. That's what the value would be. So with a clean price, you don't do that. With a dirty price, which is, there's all these dirty drinks out there now, and down in South Louisiana where I'm from, you have dirty rice. They have dirty price for bonds, and that just means it's the bond plus interest earned since the last interest payment. So if they paid interest semi-annually, which we're into July, say of this year, it would be interest plus to July. If they've already paid the interest for July, it would just be interest for the 45 day or 30 days since they paid interest. So, and then they add that to the face amount, and that's considered the dirty price. You want to make sure the bond will be repaid at maturity. That's what you want to look at for the corporation website. Or is it going to pay you stock? Figure out which way that's going to be. Do you receive interest payments all the time till maturity? And if they've done bonds before and issued bonds before, have they followed through on all of those? You can find all that information on the FINRA site. This tells you just kind of an overview. If Home Depot had a bond, what the price is. It's $99, so you know it's going to mature at 100, so you're buying it under, so you already know you're going to make $1. The interest rate's 4.5. Maturity date's is in 2032. There's the symbol to look it up. It's because it's not a ticker traded stock. It's Home Depot and then the bond number. The actual yield is the same as the interest rate for them. They're not doing anything different. They're rated by Standard & Poor's, which is one of the best rating companies, as an A. They're paying semi-annually, means every 6 months you're going to get interest. The first interest payment, it was 2/16 of 20. So if they're going to pay semi-annual and the first one's 2, probably it's going to be 2 February and August, but you can verify that and see. It's a corporate bond, and yes, it's callable. So if Home Depot finishes their project or whatever it is they got the bond for before 2032, they may call you, the callable part. They may call you and tell you that they want to cash that in now and pay you your $100 and stop the interest payments. When you're trying to figure out bond information, again, bonds are quoted as a percentage of the face value, like that one was there. It was 99 was the price. So if it's $1,000 at 99%, it means you're going to pay $990. Coupon rate, that is something you need to know for the test. So just know how the price is quoted as a percentage of the face value. If it's 49%, then it's 49 of 1,000. You'll have to know the face value to make that calculation. Coupon rates are the interest rates. Maturity date tells you when it's going to mature. Look up symbol. We went through that. Yield, and it tells you that percentage. Standard & Poor's rating, of course, is important. And then callable. So we covered all that. These are bond rating given out by Standard & Poor's, and they don't typically go. They may go to a C or a triple C, but anyway, you want to look for ones, of course, that are high, medium, or speculative, which was the one that was risky. Is a a double B or a B. So you can see that there's not a lot of wiggle room there. So you want to be sure that you're, keeping up with how it's rated. D means it's already in default. So that's an easy thing to see. And then problematic, if they're C or below, they're problematic, so that you can read the descriptions there. But a D, like I said, D is default. So you want to kind of keep it on that upper end of the letter scale there. If you want to calculate the current yield to maturity, well, there's a formula for that, of course. And what you do is take the current yield is going to be what the annual income divided by the current market value is. And then of course you can do a yield to maturity approximation. That's a whole big hairy formula. I'm not going to do that either. These you can find when you look up a bond on the website. So I'm going to let you do that. But just know that a yield to maturity is going to take into two types of return: your investment income or your interest income from your purchase date until maturity, and the payment of the face value at maturity. So both of those things will go into the yield to maturity. And what they're trying to do there is just figure out, some people really want to know in their portfolio, what kind of rate am I really making on this, versus if you buy a bond when it first opens and you hold it until 2032, you don't need these other calculations because you know you're going to earn 4.5% interest and for each year. But if you buy it partway through, or you buy it at a reduced amount, or it's already paid some interest and you don't get all the interest, is where some people want to calculate exactly what that yield to maturity is, so that they know kind of what their investment portfolio looks like. And I've got some, earning a 7% yield to maturity or whatever. Federal agency reports, you can look at that yourself. Just places you can research and find out again is Federal Reserve, Treasury.gov, SEC.gov, any of those things. Bloomberg's, Barron's, Fortune 500, Fortune Magazine, and Forbes all have periodicals and magazines that come out that you can read stuff. They all have websites you can read breaking news kind of things too. So that gives you that. And that's all I have. That is bonds. If you have any questions, give me a holler. Thanks.